Welcome to Monday Night Live, the weekly training that guides professionals to financial prosperity. Join our community and let's start building your wealth.
Welcome to Monday Night Live, particularly the guest speakers, Mike and Bethany. Mike, I'm sorry, I should have asked you. Do you normally go by Mike or Michael?
Mike is perfectly fine, thanks.
Excellent, thank you. And we have several guest students on and some brand new agents. So welcome to all the brand new agents. Welcome to the guest. We got some folks. Vince Curtin, hadn't seen you in a coon's age. Good to see you, Vince. Um, so in any case, we're going to talk about assumable mortgages tonight. And Mike and Bethany actually have a very unique platform they developed that you guys can potentially have access to if you want. And I don't want to talk too much. I want to let them show you what they've got, and let's talk about assumable mortgages because I want you to understand that there's a lot uh, more mortgages that are assumable than you might think. I know a lot of realtors are not really up on this too much, but they are assumable mortgages. You just need to know which ones they are. So Mike and Bethany, I promoted you to a co-host. You should be able to share your screen. Anything you want to share, I'll monitor the chat box if you like, but you'll be able to see the chat box too. We're kind of an informal group. Well, right now we got 33 people. We'll likely get a little bit more. I try to keep it to an hour and I'll leave another half hour for Q&A. You're welcome to hang around, be part of the group. They're usually pretty engaged and will definitely ask questions, you know?
Great. Well, thanks for the introduction, Gary. So Bethany and I, we're grateful to be here. We're very appreciative to receive the invitation, and hopefully we bring value to the group and talk about a topic that's kind of near and dear to our heart. So before we delve into the world of assumable mortgages and the platform that we built over the last 18 months or so, I figured we'd probably just spend a minute or two and just introduce ourselves. So I'm a recently retired Marine officer, 20 years. I've been licensed, thank you, PF. I've been licensed for over 15 years now. And I started my real estate career when I was, as a brand new captain stationed down in Fredericksburg, Virginia. I was stationed in Quantico. I was living in Fredericksburg, Virginia. And I was going through a captain's course at the time. And this was, if those of you are familiar with the 2008, 2009 financial crisis, and I had bought my first home in 2005, and I had orders from Virginia down to Camp Lejeune, North Carolina, and I was going to PCS, and I realized very quickly as I was getting ready to sell my house, it was not worth what I had paid for it due to the great financial crisis. So I had just graduated University of Maryland with a master's degree in business, MBA, and I just got my real estate license. And so I thought, well, let me sell my house. And in the course of selling my house, there was this program called the Army Corps Engineers Homeowners Assistance Program. And this was designed, if those of you are familiar, the Homeowners Assistance Program was designed to help relocate families after base closings, or BRAC, base realignment and closing. So there was an expansion of that program in 2009 during the financial crisis when a lot of homes were underwater, value of homes were underwater. And I was one of the first ones to apply and received approval from this program. And when I sold my house, I received a government check to cover the difference between what my home was worth and what my mortgage was and what I could actually sell it for. And I thought to myself, well, heck, if I had to go through this process and apply for this program, and I have all my friends who also had to move out of moved out of Virginia, moved to various places of the country, and they also needed help. My friends started asking, Mike, can you help me with this program? Can you help me apply for this? I need to sell my house. And so I thought, well, hey, this is a great opportunity to get my real estate license. And within 30 days of getting my real estate license, I had 6 listings. So my real estate career started as a brand new agent with about 6 listings from a couple of my friends. And I didn't feel guilty at the time having my friends be my clients because the government also paid my commission. So my friends didn't even have to pay my commission. So it worked out really well. And that's how I got into real estate. Kind of fast forward, my wife worked for the Marine Corps as a government civilian employee for about a decade. And through the course of many years, kind of deployed and back in the U.S., I continued in real estate part-time. And then about 2014 or so, I was stationed up in D.C. and really kind of doing growing a really big business in real estate. And I had orders to Japan. So really hard to do real estate when you're 12 time zones away. So I asked my wife, hey, you know, do you mind leaving your government job? And we decided to do a geo bachelor thing, which is where I would deploy forward. My wife would stay back in the States because she was working for the government and had a job, and she was getting her master's program or master's degree. So she decided to leave her government job and get her real estate license in 2015. And so now, ever since then, for about what, 8 years or so, 9 years, we've been working together as a husband-wife real estate team, which we, you know, haven't looked back since. And frankly, you know, ever since I returned back from that Japan trip, that deployment, I mostly was referring my business to my wife up until when I retired about 2.5 years ago, and then now I do it full time as well. So those of you now kind of fast forward more recently were, you know, familiar with the great interest rates that we've had 2018, 19, 20, 21, and into 22, where, you know, people were getting mortgages at 2.5, 2.75% interest rates. And then all of a sudden, was it late 2022, interest rates just started spiking, right? With the inflation, you know, the Federal Reserve had to increase rates. And so we saw huge increases in rates, which frankly, we still see them today, right? So we, you know, if you wanted to get a mortgage today, I mean, my lenders are quoting, you know, 6.75, maybe 7% on a conventional, maybe 6.25 to 6.5% for a VA. So rates have definitely peaked. And so through the course of late 22 into early 23, I thought to myself, I have all these clients, all these military clients, a lot of veterans who are eligible for a assumption loan, and we all kind of knew inherently, okay, assumption loans were part of a benefit that was offered to veterans through the VA loan program. But I said, well, you know, I don't want to tell my clients to take out a new mortgage at 6.5 or 7%. I can help them buy a home with a 2.75 or 3%. And so I started trying to research, well, how do I find these homes? How do I find these properties that have 2.5 or 3% interest rates? And it turns out there was no real way to do that. There was no mechanism that allows home buyers or agents. Theoretically, we were supposed to have more tools and more access and more resources. So, you know, I don't know, are we all different parts of the country, or we're,
Yeah,
okay,
really, we're in 38 states, and also there's guests on from multiple brokerages and even some investors on. So we
great.
got a pretty
Okay,
diverse
great.
crowd here. Yeah.
In our market here, the MLS that we use is called Bright MLS, and kind of the DC, Northern Virginia
Mhm.
market. So I called Bright customer service and I talked to the product support team. This is late 2022. And I said, hey, I'm a experienced licensed agent. I am looking for a tool that allows me to identify properties for sale that have assumable mortgages. And the guy put me on hold, and he came back 2 minutes later. He's like, I'm sorry, that's not something we do. We don't offer that. That's not on our product roadmap. Really don't know what to do to help you. So then I'm like, okay, there's nothing available to the general public to find homes with assumable mortgages. And there's no commercial tool. There's no subscription-based service. There's no MLS type tool that agents have access to that helps find these properties. So I said, I guess I just have to build it myself. And so for the better part of about a year and a half, I ended up building a platform that helps, really is designed to help agents find properties that have assumable mortgages. And we're going to talk about that today. So that's kind of the precursor, a little bit about myself and, you know, my wife here, Bethany, who is really, you know, my partner. So we have a real estate team here in Alexandria, Virginia. And then we just launched this new platform called Assumable. So I'll give a little kind of basic overview of kind of assumable mortgages, just for context, just to kind of baseline everybody. I would assume some of the more experienced agents here are familiar with them, but I'll cover kind of just a base broad overview. So assumable mortgages are exactly what it stands for. It's a mortgage that a buyer can buy, or a home buyer can buy, and assume the seller's existing mortgage. And that includes the existing interest rate, the loan terms, the The loan balance, the monthly mortgage payment, everything is identical from what the seller's mortgage is, transfers and conveys directly to the buyer. So from the standpoint of the lender, they just take the original name off and put the new buyer's name on, and everything else stays exactly the same.
Mhm.
The loans that are eligible for assumable mortgages are effectively, for intensive purposes, all government-backed loans. The three big ones: VA, FHA, and USDA mortgages. Not all markets typically have USDA mortgages, so mostly we're talking metropolitan areas. You're talking VA and FHA. And there's some nuances between those, and we'll kind of talk about those depending on what level of detail some of the questions are. But generally speaking, any buyer can assume a loan with a assumable mortgage. And so the the value is clear, right? The benefit is clear. If you have a buyer who wants to buy a home and you can cut their interest rate down, then theoretically they can buy more home for the same price, or they can get the same home for a much lower price. Kind of a nice little fun fact: for every 1% change in interest rate, generally speaking, that translates to a 10% change in your mortgage payment. So the difference between a 3% and a 6% interest rate, or say what now 6.5%, so 3% to a 6.5% interest rate, that's a 35% increase in somebody's mortgage payment. Pretty substantial, especially in our market where the average single family home is about $800,000. And many buyers are spending $800,000, $900,000, $1 million. So a 35% difference on $1 million home is a substantial amount of money. And frankly, the various assumption purchases that my wife and I have done, we're often saving our clients up to $3,500 a month in savings in a mortgage payment by pursuing an assumable mortgage. And remember, that's every month. So a $3,000 a month payment over the course of a year, we're talking $36,000 a year in interest saved every year for the time duration they have that home. So the benefits are pretty compelling. And there's some nuances about structuring offers in competitive markets, and we can certainly get into that. But the point is that we find, and this is really more for the agents out there, the agents that can differentiate themselves and offer a service or offer a tool to their clients, generally speaking, will have the ability to bring in buyers off the sidelines. So a lot of buyers out there, especially in our portfolio, who have literally been sitting on the sidelines for the last 6, 9, 12 months or longer, saying, well, I'm going to hold off. I need to buy a home, but I'm going to wait for interest rates to drop. Well, interest rates, frankly, if you look at the statistics and you look at the data, interest rates really are not going to drop. They're certainly not going to drop to 2.5 or 2.75 or 3%. Maybe they'll drop to 5.75 or 6, but realistically, we're not going to see really much lower than that anytime soon. And so the benefits of a assumable mortgage is an enduring one. It's a lasting one. There's no expectation that, well, I'm not going to buy a home now because I'm going to wait 6 months and then I'll just take out a 3% mortgage 6 months from now. Like, that is not a factor. And frankly, agents, should be helping their clients understand the market dynamics. That, if you look at the last 30 years of interest rates, 30-year average for national interest rates hovers right about 6%, right between 6 and 6.25. If you look at kind of a 30-year average, so we're just slightly above that. 2 weeks ago, we were right on par with kind of the 30-year average, 6.25. And so, maybe interest rates might drop back down to 6 or 6.25, but realistically, there's nothing compelling. There's no market data that suggests we're going to see rates drop much below that. So how do we incentivize? How do we convince? And really, not convince is not the right word, but it's really, how do you educate your clients to look at a possible purchase from the standpoint of how they can take advantage of the current market that we're in? And what we believe is one of the ways to have those conversations, to talk about assumable mortgages. So we think assumable mortgages really, those that are knowledgeable about it can use it to convert leads into clients and grow your business and generate more transactions by simply being educated and talking about the topic and having an understanding of how assumable mortgages work. And two, being able to find them and being able to present them to your leads, to your clients, and showing value to them. And then certainly for investors need to know where to find them, and those that can help find those properties. That's another win for agents. Investing in properties with assumable mortgages is a little nuanced. So we can talk about that. Certainly if there's any investors on the call that want to understand the nuances of how investing in properties that have assumable mortgage, or buying a home using an assumption loan as an investment property, is a little nuanced. Can be done. I've seen it done, but it definitely is a little nuanced. And so we can talk through that if there's any questions. I'll take a pause there. Gary, I can continue to run on. We can take this in bunch of different directions, but before we talk about the specific platform, I just thought we'd cover the basics of assumption loans.
Yeah.
And I don't know what your format is. If you generally, want to stop and take some questions along the way, I'm happy to do that.
Yeah, we can. So guys, if you want to, let's make sure we clear up any understanding or misunderstanding about assumable mortgages right now. I can tell you from my personal experience, the first house I ever bought, I assumed the mortgage. And the first house I ever sold, I let the buyer assume my mortgage. Okay. Now, back in those days, this is like 100 years ago, because you guys know I'm like 107 years old. Those mortgages, you didn't have to qualify for them. You just signed a piece of paper and that was it. And after 3 years, the seller would be relieved of liability, right? So fast forward to today, you actually qualify for these assumable mortgages. You qualify just like you will qualify for your own brand new mortgage. And yet you're not getting a brand new mortgage. You're assuming, you're literally just taking over the existing mortgage. But the beautiful thing about qualifying is, and Michael, correct me if I'm wrong, I believe that those relieve the seller of liability, right? Yeah, it's a
Immediately.
major difference.
Yeah.
Now, the other thing that pops up is, well, Gary, my client's so concerned that they sell their house, where are they going to go? And I'm like, well, you know what? You look for another property with assumable mortgages, because the other objection is, I'm going to trade a 3% mortgage for a 7% mortgage. Not necessarily true. If you consider all the mortgages that are made up of FHA, VA, and USDA, that's a lot of mortgages, guys. That's the majority of mortgages. Okay. So this is a very real strategy to help you get leads, get listings, get more buyers, but more importantly, allow people to address the market the way the market is and the way we believe the market is going. So, Anna, you have a question?
I do, yes. Speaking of qualification, specifically for VA loans, qualifying for a brand new VA loan seems to be slightly different than qualifying for assuming a VA loan. Can you talk about the difference as far as being a qualified VA or having VA eligibility for assumptions versus purchases, please?
Absolutely. Great question, Anna. So it is true. A buyer who wants to take out a new VA loan, the VA guidelines do require that borrower to have to be affiliated with the military in order to obtain their VA eligibility. So a new mortgage, a new VA loan does require military affiliation to have that VA eligibility. But to assume a loan, it's not necessarily the case. In fact, there's two ways to assume a VA mortgage. What we're talking about is specifically for VA assumptions. It does not apply to FHA assumptions or USDA. So specifically for VA assumptions, primarily just because VA assumptions tend to be the most popular form of an assumption loan. And so with a VA assumption, there's two ways to buy that loan. And we'll talk about the credit and the financials separately, but we'll talk about the eligibility and the VA component of it first. The first way is, and the easiest way is, a borrower who has their own VA entitlement can put that offer in and substitute the seller's entitlement with the buyer's entitlement. And that's called a substitution of entitlement. So every VA loan in the country requires some veteran to have their entitlement tied up with the property. It could be either the seller or the buyer. but somebody's entitlement has to stay with the home. The easiest way is always to have the borrower replace the seller's entitlement, and that's called a substitution of entitlement. And that the seller is, upon sale, that seller's entitlement is reinstated, and that seller can use their VA entitlement for their next purchase. What if the borrower doesn't have VA eligibility, doesn't have any entitlement, never served in the military? Perfectly fine. They can still assume a VA loan. However, the only requirement then, the stipulation is the seller has to be willing to leave their entitlement with the property upon sale. So what we found is about 50%, at least in our market, about 50% of sellers are willing to leave their entitlement with the property, and 50% need it or want it back for a future use. And I'll just give you some examples of cases where the seller may not need it. And in doing so, remember the pool of potential buyers grows substantially, because if the seller doesn't need or doesn't want their entitlement again, they can leave that with the property, and that opens up to a greater number of potential buyers who could assume that loan who don't have VA eligibility. And some of the circumstances may be, I can think of three off the top of my head. The first one is the seller, maybe they have enough equity in the property, and when they sell that home, they're going to take that cash plus any other cash that they saved, and they're going to go buy their next home cash. And that's, kind of common in our part of the country, where, it's not uncommon for sellers to walk away with several $100,000 of equity, and then they move out to the Midwest and they can buy a really nice home for, $300,000, and maybe they have enough they can buy the home cash. The other scenario is maybe they're retiring and they already own another home somewhere else in the country, and they're going to retire and move into that house, and therefore they don't need their entitlement anymore. And then the third scenario is, and this is again somewhat common, is we see a lot of kind of retirees who are retiring, and maybe they're going to move in with family, and therefore they don't need to buy another home because they're going to live with family maybe the next generation or so, and therefore they don't need to reinstate their entitlement because they don't have a need to go buy another home after their current home sells. So we find that those kind of scenarios exist, and if the seller, again, just to recap, is willing to leave their entitlement with the property, then that opens up to anybody, to include investors, buying VA homes as an investment property. Because, and this is kind of the other big point, is if the seller leaves their entitlement in place, then the buyer is not beholden to any of the VA requirements for owner occupancy or primary, being a primary residence. So that means, and that's really the scenario in which an investor could assume an existing loan, is really the only scenario is that the seller's entitlement has to remain in place. Anytime there's a substitution of entitlement, or anytime that the borrower uses their entitlement with an assumption, then that triggers the same VA requirements, which is that it has to be that borrower's primary residence, and it has to be at least owner occupied, generally speaking, within 60 days upon closing. That borrower or that buyer who bought the home has to move into the home. But again, that's applicable only to properties where the borrower's entitlement is substituted by the sellers. Now, take a step back. So in terms of kind of credit requirements and qualifications, basically anybody who's already pre-qualified or can obtain a pre-approval letter from any lender, generally speaking, they'll also be eligible to assume a mortgage. Remember, government-backed loans, for the most part, have less strict, or in other words, saying more lenient underwriting guidelines than, say, a traditional conventional mortgage. So as those of you who are familiar with VA, and this same goes for FHA, they have a lot higher debt to income ratios. They have lower credit score requirements or minimums. And so they're a lot more forgiving and a lot more lenient when it comes to applying and taking out an FHA or a VA loan. And those same guidelines apply for assumptions. So if you have a borrower who can get pre-approved with a conventional mortgage or is pre-approved with a VA loan, then by default, they will already have met the requirements for an assumption, because those same credit requirements and loan to value ratios apply for an assumption. So it's generally speaking easier to qualify for an assumption than it is for a conventional mortgage.
Okay, that's very good explanation too, by the way, Mike. I appreciate it. Lisa, yeah, I think you had a question, Lisa, and then there are some chats also we have to get to, Mike.
Sure.
I did have a question. I recently sold a property to some buyers that on the listing it said that it may be assumable. When it came down to possibly writing an offer, we spoke to my buyer's lender, and he was working. He was originally going to go VA. He could do anything, but he was going to go VA. His lender said, well, that mortgage won't cover. Now, he knew no figures. That won't cover as much as this buyer needs. So that really won't work. And my first thought was, he doesn't know what he's doing. And my second thought was, and this is my question, how are they getting paid on this? Is he going to make less money if he does an assumable, maybe with a second, than he would if he just did a traditional first?
Yes. Yeah. Lenders, do we have lenders on the call?
I don't think so on this one.
Okay, good.
We can
So
talk about them.
I could speak freely. We can talk about them, right? All right. So this is the dirty little secret that lenders don't want to tell you when it comes to assumption loans is they don't make money on them. Especially with VA, the maximum amount of money that a VA, a servicer is allowed to charge for an assumption is $300. So a traditional lender, if you have a local lender or one of the credit unions or banks, they make money when they sell that, either when they originate that loan or when they sell it on the secondary market. Those lenders make money when they originate those loans. They would much rather you take out a new mortgage than, and they'll try to incentivize you to do so rather than kind of, tell you it's acceptable to take out or I'm sorry, to assume an existing loan. There is very little money for lenders with assumptions. In fact, that is part of the challenge that buyers and sellers have had with this whole assumption industry is even the existing servicers, the servicers are the ones that are processing these assumptions, don't like to do them because they don't make any money on them. And it's a time intensive. They have to do underwriting on a loan they're not going to get paid on. They have to approve the assumption. There's no money there. And so there's been a lot of latency, and you'll hear a lot of horror stories about taking 4 or 5 months to get an assumption loan approved. And I've certainly had my fair share of those as well. And we'll talk about, there's a new VA circular that puts an end to all of that. But Lisa, to answer your question, yes, a lender will generally tell you not to do an assumption because they're losing business. They won't make money unless they can issue you a new first mortgage. New first mortgage is where the money is from the lender in the lending business. It's not in assumptions. And even second mortgages, I work with a lender who does issue second mortgages. Remember, because the one of the challenges with assumption loans is the borrower typically has to come up with the difference between the loan balance on that mortgage and the sales price. So if you have a home that's listed for sale at $800,000 and the owner has a mortgage balance of, say, $700,000, well, that borrower has to come up with $100,000 cash to assume that VA loan. There's no such thing as 100% financing in the world of assumptions. There's got to be that difference, generally speaking, has to be made up by the borrower, that buyer. And if the buyer has the cash, great, keeps things really simple. If the buyer doesn't have the cash, there are options for second mortgages, but most lenders don't offer them. And those that do really don't make any money on them, so they don't typically like to do them. So that's just another little nuance about assumptions that, that kind of complicates matters, especially when buyers don't have a lot of cash to cover the difference.
Yeah.
Thank you.
Yep. Let me answer some of the questions in the chat.
Yep.
So when would the seller sell with its new mortgage, and what are the benefits for the seller? So that's a great question. So we took it from the standpoint of what's the value for the buyer. We just talked about that at length. Lower interest rate. There's no appraisal that's required for an assumption. There's no lower closing costs because you don't have to take out a new lender's title insurance policy because the existing lender's title insurance stays in place. So it could be several $1,000s of savings in closing costs for the buyer. Well, what about the incentive for the seller? And that's one of the things that, in our market, Northern Virginia, where it's a strong seller's market, right? So you have homes that are selling in the first weekend, after 24 or 48 hours, listing agents are getting multiple offers. And so if you are representing a buyer and you're putting in an offer to assume the loan, how are you going to compete against a conventional loan that's, say, closing in 3 weeks, that has no contingencies? well, one, we don't have to worry about an appraisal. And two, what we like to do is we try to incentivize the seller to take that offer over other offers. And the best way that we found this to be successful, this is going into some of the strategy. So those that are interested in how you really make assumption loans work, here's what we found that works. You calculate what the savings is, what the borrower, the buyer's savings would be if they were to assume that mortgage. So you look at it, okay, if they had to take out a new loan at 6.675 or 6.75, whatever that mortgage payment is for a 6.75, whatever the current rate is of the day, current interest rates, calculate their mortgage payment, you know what that number is. And then you find out what the mortgage payment is on the assumption loan, and you find that difference. You know, and let's just say that difference is, you know, $2,000 a month. So you take $2,000 a month, and what we like to do is, and this is kind of up to discretion, you know, what you think, but we basically we take is, okay, let's just take the first 12 months of savings and offer that up as the incentive to the seller to take the offer. So basically we're saying is about 24, let's just come up with an easy number, $25,000. We're going to offer $25,000 to the seller above what we would otherwise offer, because we're going to save $25,000 a year for every year we own that home. So what's wrong with giving up, you know, the first 12 months of savings? Because that's probably what, you know, you're going to have to put the seller in some type of kind of dilemma, we call it. Those are military terms, horns of a dilemma. The seller is really going to have to think, do I want to take this conventional offer with no contingencies? It's closing in 3 weeks or 30 days. Or do I want to take this risk and take this assumption loan where it could take 60 days or longer to close? And so, well, then you're going to put the seller in a dilemma, like, well, I guess if I'm going to take this conventional loan, I'm giving up $25,000. Do I really want to do that? Or do I want to take the extra $25,000 knowing full well there's no appraisal? So there's no appraisal issue. There's no concern about it not appraising because there is no appraisal. So the borrower is not worried about that. That risk is off the table. And what we do is we write these offers up and using the power of the savings as an incentive to offer to the seller. And usually it's done through a higher offer than what would otherwise be given with some of the other competing offers. And that tends to work quite well because you're putting the seller in a position to take your offer and make more money, or they'd be leaving money on the table or giving up money by taking another offer. And that's not typically what sellers like to do. Which one? Oh, Dutch raised his hand. Please, Dutch, go ahead.
Does the opportunity to assume a lower rate put the, we're talking about saving money, allow the buyer to qualify for more?
Yes, it does. It does, absolutely. So whenever you, or if you're representing a borrower, a home buyer, prospective home buyer,
Right.
You're going to need to come to the table with an existing pre-approval letter from any lender, right? Generally, you work with a preferred lender. That preferred lender is going to pre-approve them or pre-qualify that borrower based on current market interest rates.
Okay.
So if that borrower, and whatever price home you want to come up with, let's just use that same $800,000 home price. So if that borrower can qualify and get a loan for $800,000 with current interest rates, then you're darn well sure that same borrower is going to be able to qualify with a much lower interest rate. Because remember, for every 1% decrease in interest rate is a 10% reduction in mortgage. So remember, if it goes from a 6.5% to say a 3% interest rate, that's a 35% reduction in mortgage payment. That's going to significantly reduce the loan to value or debt to income ratio. So the debt to income ratio is significantly improved for borrowers who are pursuing an assumption loan. And that's why really having a homeowner who's putting an offer in to assume a loan, borrower qualifications and financials are much easier because of the lower interest rate to qualify for than that borrower taking out a new mortgage and having to qualify for that same price home if they had to take out a new mortgage at 6.5 or 7%.
Right. So where I was going with the question is sometimes our buyers can't qualify for that $800,000 house unless they get an assumption. And if they get an assumption, they will qualify, they may qualify at the lower rate so they can afford the $800,000 house when they couldn't before. So we may get some people that are not qualified for the higher priced houses qualified for it. So we're letting more people into the market.
We are. That's a very good point, Dutch, and you're absolutely correct. In fact, we have many buyers who have been literally priced out of the market. They were able to qualify for a mortgage when they can get a 2.75 or 3% interest rate. And they are literally at 6.5 or 7%, they are priced out. They cannot afford a home. The only challenge that I can think of with that kind of scenario is if you're selling your home, if you're representing a seller and you're the listing agent on a property, and you know that home has an assumption mortgage or assumable mortgage. The challenge though is if a buyer comes to you and wants to assume that mortgage, if they don't qualify for the home if they can't submit an offer with a pre-approval letter, then there's no mechanism you have as a listing agent to do any due diligence to ensure that they would even qualify for it as during the assumption process. And as a listing agent, you really have to weigh that risk. So maybe they could qualify for at the lower rate, like you said, and frankly speaking, we know a lot of home buyers would in fact qualify for bigger home or maybe the same price home that they wouldn't be able to otherwise under current market interest rates. But unless they can show up to the table with a pre-approval letter, it's a really risky proposition that we're putting listing agents in.
You can do it based on listing. You could do it based on monthly payment.
Yeah.
If they can qualify for this monthly
So
payment.
so Bethany's pointing out some lenders will give you a pre-approval based on a monthly payment. So as long as we know that the purchase falls within that monthly payment, then they may still qualify. That's another way of doing it.
That's a good idea. Okay,
Yeah.
Caveat, just be careful. Be careful.
Yeah.
That's the
Yeah. We want to do a due diligence, right? So we always want to, as professionals within the industry, we always advise our clients to the best extent possible. At least in our office, there's a lot of agents who have us included, have extensive experience with assumption loans. And so, I would say it's not very easy to get yourself into trouble, but like you said, you just want to make sure that, if you're going to represent a buyer in a purchase, you want to at least do due diligence to make sure they're qualified. I mean, you don't want to waste your own time, and you certainly don't want to waste the buyer's time, in that process. So that's what I would say.
Thank you.
You're very
answer.
welcome.
Yeah.
Gary,
Thanks for the question, Dutch.
There's
Yeah.
a lot of questions here in the chat. How do you want to do this, Gary? You want to start going through them all, or you want to just
Yeah.
have people chime in?
Yeah, the ones from JS, actually there's follow-up questions. If you can cover the ones from JS, and there's
Sure.
just one more from Karen. Yeah.
Okay, so we talked the first one. How do you qualify someone for a buyer for a assumable mortgage? So there's nothing we need to do as real estate agents. All I would do is anytime I represent a buyer who's interested in assuming a mortgage, I would just have them pre-approved with a regular lender, and just if they show up with a pre-approval letter, they're good to go. I know they'll qualify. So I just make sure that they get a pre-approval letter from a local lender for a certain price home. And then that's really all you need to know is that they meet current qualifications. So if they can meet the qualifications for a home price at current interest rates, they will, generally speaking, qualify with ease on any assumption. Next question why would the seller leave their name and allow the buyer to make payments? They won't. So one kind of misnomer about assumption loans is when a buyer assumes that mortgage and the seller is that home sells, that seller is 100% clean. There's a distinct and clear cut from any seller responsibility. The seller no longer has any ties to that mortgage. There's no risk of default from the seller standpoint. So even if the new homeowner stops making their payments or forecloses or defaults on the loan, that does not impact the seller's credit score. It does not impact the seller in any situation, with the exception of one minor scenario, and that is, remember we talked about the entitlement. So if the borrower's entitlement, VA entitlement, replaces the seller's entitlement, then the seller is 100% free and clear of that loan, and there's nothing that could ever come back and bite that seller. If the seller's entitlement stays with the property and the borrower defaults, the seller could potentially lose their VA entitlement going forward, because technically the loan that they had defaulted. It won't impact their credit because it's not tied to their credit anymore, but it could impact their VA eligibility. So there is a little bit of a nuance there, depending on what happens with the new borrower if the seller's entitlement stays with the property. But just keep in mind, there is what's called a release of liability that comes with every assumption. So whenever upon closing, that release of liability letter is stated, is included in the package, and sellers are always released from liability anytime an assumption clears, once it clears closing process, just like any other sale. It's exactly like any other home transaction. And again, so the seller is not on the loan anymore and is not tied to the loan at all going forward. When does the seller get relieved of the debt? Upon closing, just like any other transaction. Once the transaction closes, the seller has the title is transferred, the loan is transferred, and the seller receives their disbursement, and they are scot-free and clear, and they are no longer obligated to that mortgage, and they get a release of liability stating as such, and they are completely free from that property. What if the buyer wants to sell and move out? No impact. It doesn't change to how any other transaction works, any other home purchase works. So you get a buyer who assumes a mortgage. A buyer can close on that property, live there for a month or two, or live there for 5 years. They can rent it after they move in. Technically, unless it's an investment property where the seller's entitlement stays with the home, usually if you do a substitutive entitlement, that does require the homeowner for it to be their primary residence. But really, just like any other VA loans, if any of you have worked with veterans, it just has to be your stated purpose or your intent to move into the property as your primary residence. But there's nothing stopping a borrower who just assumed the mortgage. That property can become an investment property later. It can become a rental property, and all of that is fair game. So that new buyer can sell that property and do whatever they want with it. There's no restrictions tied to that whatsoever. The other little fact is, remember we talked about if the seller's entitlement stays with the home and the buyer uses that seller's entitlement, if that buyer either refinances the home or if that buyer sells the home, at that point, that seller's entitlement is reinstated back to the original seller. So anytime if the new buyer sells the property or refinances the property, that also frees up that seller's entitlement and gets reinstated. So it's not a permanent, doesn't permanently occupy that seller's entitlement. What is in it for me to do such a transaction? So from an agent standpoint, remember, typically when a home is listed for sale, it's advertised with a commission. That commission applies whether it's a standard purchase or an assumption. No change, no impact. So if it's listed with a 2.5% or listed with a 3% buyer brokerage commission or buyer agency commission, then you're entitled to that upon closing, just like it would be for any other transaction. So from the standpoint of a commission, there's no change, no impact, whether you do a traditional purchase or whether you do an assumption. Whatever's advertised in that listing, you're entitled to.
Hey, I want to pause briefly to talk to you about your business and specifically your leads. I know volume was low. I've been in this business for 38 years. Volume is as low as it's been in the last 30 years. On our team, we have our own lead generating system. We not only give you leads, we give you your own lead account. All these leads are yours. They go in your database, not in the team database. They go in your database, okay? All the sales, all the listings go in your name. They don't go into team, they go in your name. We have our own training programs to teach you how to invest and how to work with investors, and we coach you one-on-one. And here's the best part of all, our split is only 25%. You don't pay for anything out of pocket. Everything you get comes out of your low 25% split, and that's not even permanent. That's a temporary split. After a few transactions, you go to a 5% split. That's what you pay forever, and you still get all the coaching, the leads, the marketing, the training, everything you need. Okay, this is real, and it's happening right now. Click on the link below. It's in the email. If you're watching this through another platform, just go to globalinvestoragent.com, scroll down till you see the join form and fill it out. Otherwise, it should be in the email that you're watching this from now. Okay, I look forward to talking to you. Don't wait. Think about what you're getting now and think about what I just told you. Think about what you've not been getting and think about what you could be getting. All right, just click on the link. We'll do a quick interview. I'll analyze your business and we'll see if this is a fit. I look forward to talking to you. Bye-bye.
So Karen asked, can the seller carry the second if there's a balance to be made up? Karen, I don't really understand the question. What do you mean carry the second?
I think seller, so have that be like a seller financing the second.
Okay, so are we talking about seller financing? So we're getting really into like advanced class here. So for those still taking notes and haven't lost everybody, some servicers don't allow second mortgages on assumption. And that causes a problem. If you're assuming a mortgage and you have a borrower who doesn't have enough cash to cover the difference between that loan balance and the sales price, the borrower is going to have to take out a second mortgage. Well, the problem is not all assumption loans have the ability to take out a second mortgage. And that really is dependent upon the existing servicer, the current lender who payments are being made to. And this is separate. This is outside the hands of the VA. But I would say most allow second mortgages, but some don't. If you really want to know why they don't, I can get into it. But that in that scenario, let's just say a home buyer needs a second mortgage, but the servicer doesn't allow a second mortgage. We found one of the ways around that is to do a seller financing of the equity of the property. So let's go back to this example, $800,000 home. The current loan balance is $700,000. The home buyer doesn't have the $100,000 cash. That seller could offer seller financing, usually a short duration, 12 months or 24 months, usually structured in kind of like a balloon payment where it's due all at once, say at the 12th month. And that seller is basically loaning their equity to the borrower. The borrower can close on the property without taking out a second mortgage. They have that $100,000 equity that was provided through a seller financing deal. Upon closing, now the seller owns the property. The seller would take out a HELOC, usually a HELOC or a fixed equity loan. And remember, interest rates on a HELOC are significantly better than a second mortgage. They pull the equity out of the property, and then with that equity, they pay back the seller. And they basically make the seller whole. And it may take 6 months or so to get that HELOC in place. And that's why usually they're short duration, usually 12 or 24 months for seller financing the second. And that's a way around the rules if for whatever reason that lender is not allowing a second mortgage to be issued at the time of purchase. And we found that to be successful as well. And frankly, if the seller is willing to do so, it actually benefits the buyer because the buyer will get a much lower interest rate on a HELOC because they already own the home than taking out a second mortgage.
Thanks for that explanation too, Michael, because we talk a lot about creative finance and there are a lot of ways around things. So I think that, and that's one of the reasons that I asked if the seller could finance the balance. Yeah,
that's a great question, Karen. And that's really kind of advanced. The seller would have to agree to that scenario. We've done that once before, and certainly it's a great opportunity. And if as an agent, if you can kind of package something up like that, it really makes you look really good. I mean, the eyes of the borrower. I mean, you're going to get a lot of referrals after that transaction because of putting something together like that. Dutch, go ahead, please.
So in that scenario, if the 2 or 3 year balloon, maybe it's got some nice payments on it because it's non-qualified that time, you can take the note and sell the note at a discount and recover the cash back to the seller by selling the note. That's another step.
Yeah.
But
yeah, you can take this a bunch of different ways. Certainly, I just gave you one solution, the seller financing option, take out a HELOC, reimburse the seller upon closing. the seller can sell the note. There's all kinds of different ways to do it, but yeah, I mean, it's as creative as you want to be, but remember, typically simplicity wins the day.
Go to the servicer.
Because the servicer often has a say in this, and you really want to minimize their ability to weigh in and shut down these opportunities. So, so seller financing usually, like as I explained, it tends to be the simplest and least intrusive, where the seller just, okay, fine, if you're going to do it that way, that we're fine with that. They don't want you to take out a second mortgage with another lender and have a second place position with another institution. And the reason being, just kind of for those that, since we're asking really good questions here, since there's no new appraisal on a mortgage, on assumption, right? There's no appraisal, it's ordered. The servicer can only go off of the original notice of value, the original appraised value from when the home was first purchased by the current owner, the current seller. So many cases, servicers don't recognize appreciation. So they don't recognize the fact that that home value went from 700,000 to 800,000. So why would they allow a second mortgage to be taken out? Because there's no new appraisal to say that the home is worth 800,000. So a lot of servicers don't allow that second mortgage because there's no new appraisal order. They have nothing. There's no documentation to validate why or where that second mortgage is, the equity of that second mortgage, or why they would allow it to happen. So it's really just a risk mitigation measure from the primary lender. Craig asked, a 1% decrease in interest rate equates to what? So 10% reduction in your mortgage payment. So 1%, 10%. So every 1% decrease in interest rate is a 10% reduction in a mortgage payment. Let's see here. Have you ever triggered the due on clause sale? No. Well, due on clause, or due on sale clause. Yeah, the due on sale clause. So no, because remember, this is another little fact. You hear a lot of agents out there that will say, I couldn't get the servicer to approve the assumption, so we gave up. Here's what a lot of agents, you'll become very more effective if you know this little fact. VA assumptions is an entitlement. It is a guaranteed government benefit. Servicers do not have the choice to decide whether they want to approve it or not want to approve it. The only factor, the only criteria servicers can use to approve an assumption is the borrower's financial qualifications. They have no choice in saying, well, we're not processing assumption loans now. I'm sorry. It is a government guaranteed benefit, just like any other benefit guaranteed by the government. It's an entitlement. And as you all know, entitlements are guaranteed. So servicers actually do not have a choice in whether they're going to process an assumption. It is a guaranteed entitlement. So it does not trigger a due on sale clause. Servicers cannot, it is illegal for them to require the loan to be paid in full upon an assumption. Illegal, it's a guaranteed entitlement. They have to process that assumption, and they have to process it. They don't necessarily have to approve it if the borrower is not qualified. Maybe they don't meet their credit requirements, or they have a low credit score, or maybe their debt to income ratio is insufficient. That certainly would be a justification for not approving it, but they don't have a choice whether they will process it or not process it. They have to process assumption, and no, they cannot trigger a due on sale for an assumption. Next question, is the buyer coming to the table with a bigger down payment? So yes. Okay, so no. So whatever the loan balance is on the existing VA loan, that amount has to be paid at closing. You cannot contribute more. You cannot further reduce the loan balance during an assumption loan. So you can't take a $700,000 mortgage, add $50,000 to it, and then ultimately reset the mortgage payment with a $650,000 loan balance. You cannot bring additional money to the table to reduce the loan balance. Whatever that mortgage payment is, whatever that loan balance is, has to carry forward for the purchaser. And there's normally, how we always, for a traditional purchase, the principal interest that's due for that month of closing is paid, and then you get 1 month off, and then your first mortgage payment. So that doesn't apply with assumptions. So if the seller made their last mortgage payment on February 1st, and you close on February 25th, then the first mortgage payment is due March 1st. There's no break and there's no gap in when the mortgage payments are due. So there's a direct correlation. The last payment that the seller made, the very next month is the next payment that the buyer must make. There's no gap. And you cannot change the loan balance during assumption. JS asked, so whatever so far you mentioned, does it apply to VA loans only? So everything with the exception of the entitlement piece applies to FHA properties as well. So there's no FHA entitlement that there is like VA entitlement. So if you take the entitlement component out, anybody can qualify for an FHA loan or FHA assumption as long as really kind of two things. One, they have to meet, the underwriting qualifications. So that's income ratios, income requirements, those types of things, which again, if they can qualify for an FHA loan anyway, they will qualify for an assumption loan because the interest rate is going to be lower and therefore the mortgage payment will be lower. So the debt to income will be lower. But two, the second piece is with FHA loans, all FHA properties, at least when they're assumed or purchased, you can't buy an FHA loan as an investment property and you can't assume an FHA loan as an investment property because they have with this owner occupied clause built into them. So FHA assumptions do require the borrower, the homeowner, the buyer for it to be a primary residence. So at VA loans, a little bit nuanced. If you're doing a substitution of entitlement, the VA loan has to be a primary residence. But if the seller's entitlement stays with the property, it can be an investment property and the buyer does not have to move there. With FHA properties, it has to be a primary residence home for an FHA assumption. I think I covered all the questions in the chat.
But Bonetta's got her hand raised. And guys, I want to say something real quick. It's thanks to Bonetta that Mike and Bethany are actually here. So Bonetta introduced me to Mike and Bethany. So Bonetta, first of all, thank you for making the introduction, and go ahead and unmute yourself and
You
take the
do an
mic.
awesome job, Mike. Hey, Bethany.
Hi,
Hi,
Benetta. Thank you so much for connecting us. You guys have asked some really, really good questions. It's been
They
Yeah.
are. They're asking questions that I wouldn't even know to ask, and I'm
this
glad
is a sharp group.
that we're having this conversation because I was like, wow, I wouldn't have even known to ask that. So my question is this, Mike, you mentioned that the buyer could get a HELOC to pay the difference between what is owed and what the sales price is if they don't have the cash. However, how can they get a HELOC before they own the home?
No, they do seller yeah, great question. So they have to do seller financing. That's why I talk about that short duration balloon, kind of 12, 24 month seller financing.
Okay.
So the seller is going to issue them financing with, a mortgage payment, a monthly mortgage payment, et cetera, which is basically the seller loaning them the equity in that property that they won't get a second mortgage out. That second, they're issuing them a seller financing or a seller's second mortgage. And then when they close on that property, that gets them to allow them to close. And once they close and they own the home, then they take out the HELOC.
Gotcha. All right. Thank you very much. Y'all doing an awesome job.
So Gary, do we have a few minutes I'll give a quick 5-minute demonstration of the Assumable platform?
Absolutely. Yeah, we do have some more questions, but go ahead. Let's go into that second part of the presentation. And Juwan Bond on the team in Arkansas actually has a live transaction right now she wants to ask you about, but let's do the presentation first and then we can get back to the questions,
Okay, great. Let's do that. I'm just going to put my contact. I'm just going to put the website and then my email address in the chat. Folks, they can reach out to me via email. I think it's the best way to reach me. Yeah. And I'll just do a quick demonstration here and then we'll kind of wrap it up if there's any follow-on questions thereafter. Let's see here. Okay. So Assumable.com is the website. Find homes for sale with Assumable mortgages. A lot of this website is really geared around just educating buyers and in some cases agents about what assumption loans are, much of which we talked about here in this call. There's a quick video, like a 2-minute video about the platform itself. There's some scenarios, I use this $800,000 scenario because that's kind of what, kind of makes sense, given, what the average home price is, at least in our market. We do offer a 7-day money back guarantee. And then down the bottom here, there's a bunch of blog articles that gets into some of the more details about what we talked about, you know, and certainly there's some information here if you have buyers that are interested in assumption loans. What are the steps? How does it work? Are VA loans assumable by non-veterans? We talked about that at length tonight. So really recommend kind of taking a look through this website and you know, kind of familiarizing yourself. You may find some good information that you may not have previously known about assumption loans. We're not nationwide yet. We are growing as quick as we can. So we're in the list of states here. In fact, California will be in Southern California within the next week to 2 weeks or so. We're just getting the final steps turned on. We're in Delaware, Florida, Maryland, New Jersey, Pennsylvania, Virginia, DC, and parts of West Virginia. We're growing into just kind of, I'll just shout off some areas which we'll be launching in the next couple of weeks to a couple of months. Is Colorado, Arizona, Texas, North Carolina, Georgia, and probably Kentucky and maybe the Midwest and the Chicago and Ohio areas, and then maybe somewhere into the Northeast region within you know, by the end of the year. So and the challenge is it's really difficult to grow quickly, because one of the things that we do differently than some of the other services out there that claim to be able to help people with assumptions is that we're connected to a live MLS feed. So we have to operate, be licensed, and be, you know, part of the Realtor Association boards and all those things that goes into how this platform works, which is really the value here. So what I'll do is I'll do a quick demonstration. It is a subscription-based platform. So there is generally speaking, a monthly subscription. And what we'll do, Gary, is for your group, I'll do a discount code. And so, you know, if you wanted to tell me, tell me what, I'll create like a discount code and I can share that with you, and then you can email that out. Yeah. I haven't created that yet, but I'll create a discount code for this group, and then you can certainly use that to kind of offset the cost. But I think it's just for a nominal fee. I think you'll find that it brings a lot of value, and we're adding a lot more capability to it as well. And I'll share some of that with you now. But when you log in, you're greeted with a dashboard. You can save properties and view the properties that are saved. You can save specific searches and search criteria. There's some statistics here. I'm actually going to remove this because this is unique to our market. I think we're going to probably talk more about trends with interest rates, or maybe market statistics overall. And then there's some mortgage news and insights. Really just talks about where interest rates are heading. A lot of forecasting in here, where interest rates are headed. But what's really important is the stuff on the left here. And so right now on our platform, we have, you know, over 5,000 active homes with assumable mortgages, another 1,000 or so in coming soon status, and there's, you know, a couple thousand in pending or under contract. But below that is really the kind of the really cool stuff, and that is off-market homes with assumable mortgages. There's nearly 1 million properties, which will soon become about 2 million properties over the next few weeks as we expand into California and other markets. And then we break that out by state. So each state has a list of the total number of off-market properties, or total number of assumable properties, based on the map that I showed you on the previous page. So for example, you know, Maryland, we cover the entire state of Maryland. So the entire state of Maryland has about a little over 250,000 assumable homes, and all 250,000 of them are searchable on this platform. So when you log in, you click on property search, and I'll just do a quick demonstration. There's 3 tabs on the top. Live MLS search, which no big deal for this group. You can search every listing in the MLS. There's the assumable home search tab, which searches for actively listed homes active on the market that are assumable, and only display homes that have assumable mortgages. And then there's an off-market search, and I'll do a quick demonstration where you can search for off-market properties. So assumable home search. So, you know, I'll just go with my area here. So if I want to see, you know, homes in Alexandria, Virginia, you can just type in Alexandria. You can also search by county. You can search by zip code. You can search by the name of a neighborhood. You can search by a specific property address. So I found the property in Florida, Newport Richey, Florida, on New Alexandria Loop Road. So we're going to search for Alexandria City, and it'll give a map. It'll update a map, and this map is dynamic. You can zoom in and pan, and you can view, and it automatically updates the properties on the right. So anybody's familiar with any kind of IDX or web search or web platform this will be very familiar to them. and it just breaks it out what's active, coming soon, and pending. And you can kind of search through this, and you can set criteria. If you want to set a max purchase price or a min purchase price, you can do that here. If you want to set the number of bedrooms and bathrooms, if you only want to look at homes that are, say, active or coming soon status, and you only want to look at homes, say, you don't want to look at condos, maybe you have a homeowner or home buyer is looking for single family and townhouses. And so based on, kind of a little bit of criteria filtering, I came up with 9 properties in Alexandria, Virginia that is active, that are single family and townhouse, that has a max purchase price of about $1 million. And so that's kind of what this search is. So let's pull up this one here in Old Town Alexandria, 515 Queen Street. So you can immediately search through the photos right on the map. And it tells you it's assumable, it tells you it's active, and it tells you how many photos and some basic information about the property. So once we click on it, this is where it gets really, really cool. Because in here, this is where it tells you the list price of the home as a VA loan. The home is for sale at $685. The current loan balance is $583. So this home needs about $100,000 down payment to cover it, to assume that mortgage. It has about a 2.5% interest rate. It's 2.58, but generally speaking, this is just an estimate. It's pretty close, usually within plus or minus of 0.25%. But remember, interest rates are only known by the borrower and the servicer. So there's some really Gucci kind of high-speed math that kind of helps us figure that out. But generally speaking, this home has about a 2.5% interest rate, and the mortgage payment on this property is about $2,500 a month. And all that's provided here on this page. We know that the home was bought in 2020, October 2020, has not been refinanced. And then, details about bedrooms, bathrooms, square footage, taxes, and anything else that you would normally see in the listing, you would see it here. And then really cool, has walk score, has a Zillow for Z estimate, which doesn't apply in this case, but when I show you the off-market listing, that does apply. Any community features, the schools that it's in, and then the property owner. So this owner tells you the name and the address of the owner. And if this was a rental property, it would tell you the mailing address of the owner, so that you would know if this is a rental property. What I want to show you is, let's just say, there's 2 things I want to show you. So let's just say you have this property and you want to share it with a client, and you have a client interested in buying in a particular neighborhood, and you found them a home. You can click on share. You can create a link, and then you can, let's just say it creates a link for you, and then you open this up and you wanted to share this with the client, and this is what the client would see. The client will see the agent's name. So I'm logged into Bethany right here, the name of your team. We're adding in the ability to add custom branding. So you can put your team logo or your brokerage logo up here. So effectively you'd have it branded to yourself. You'll have your photo. Again, your contact information. So this is a branded listing, a branded property listing, that then you can share the interest rate. So you can really kind of get your client excited about this property. And also what's really cool is if you wanted to say, if you have a listing that has an assumable loan, you could create a shared link and you can post that on social media. And any inquiries, anybody that submits this, inquire more about this property, those leads will be submitted directly back to you, the agent, and you can use as a lead following or lead capture technique to highlight or showcase a listing that you have, and you can generate leads off of this listing. Those leads will be sent directly back to you when anybody submits that inquiry card. The other thing I wanted to show you is, I'm going to go back to the off-market search. So now we're searching for properties that are not in the MLS. Let's just go with, let's just say Tampa, Florida, because we're live in Tampa. So we go into Tampa, Florida, and let's just pull up a property here. I don't know, I'm going to keep it kind of really simple. Let's just take this one here. Oh, great, it's got a nice pool. So we click on it, we open it up. Let's just say you have a buyer who wants to buy in that neighborhood. There's nothing for sale, and you found the community that they want to buy in, and you found this property here. This property was purchased in 2010. It was refinanced in 2022. It has a VA loan. If it had an FHA loan, it would say it. has a 3.75 to 4% interest rate, which is still really good, and has a loan balance of a little over 400,000. What's really cool about this is that one, it's unlisted, so there is no listing agent. But two, if you really kind of want to know who the owner is, you can click on the property owner, and we built in a skip tracing feature. Sorry, my daughter's here with me, so I apologize. We built in a skip tracing feature, so you can click on this button and it will display the homeowner's cell phone, if they have a landline, and email address. So if you wanted to contact the homeowner and say, hey, Mr. and Mrs. Homeowner, I've got a prospective buyer who wants to buy in this neighborhood. There's nothing for sale. I saw you purchase this home, has a really good interest rate, and has a assumable mortgage for the right price. Would you be interested in selling your home? And maybe some buyers may not be interested, but some buyers may absolutely be interested. And so this gives you the opportunity to not only find off-market properties, but now we provide the ability to search, to provide you with the homeowner's contact information so that you can prospect market communities or specific addresses and reach out to those homeowners. And theoretically, short of door knocking, really there's no other way to do it in the past. And we think that's a really powerful tool to help. Again, it's another service that you offer to your clients to help find them assumable properties. I'll pause there. Any questions?
How did you come up with the down payment?
I'm sorry, I missed that. Was that Tony? Do you have a question?
Yes, I was wondering, how did you came up with a down payment? How did you come up with that again?
So yeah, one thing that we're actually tweaking, it'll be released in about a week from now. So right now you kind of have to do the math yourself. So the loan balance on this property is $408,000. We don't know what the home is worth. Let me find a better property here. Let's go. Let's see if, let me just find one here. Do one down here in the heart of Tampa here. Let's find this property. Let's see what this is. So this home was last sold in 2009. Oh, wow. So look at the loan balance, $77,000 on this FHA. So this one is probably not a viable assumption because it's just too much of a gap. So that's not a good option. But let me find another one, maybe see if this one works. 2010, again, last sold for $420,000. That's strange though.
Yeah.
How could the loan balance only, they must have had a substantial down payment. Really what I'm driving towards, let me do Alexandria, because I know there's parts of Alexandria will be a little bit better, easier to explain this analogy here. So this is an Alexandria.
What's your daughter's name?
Oh, this is Sarah.
Hey, Sarah.
So this one was sold in 2022 for $785,000. And the reason why I include Zillow, because rather than having to run the comps and say, okay, what is the home actually worth today? What would be, we know what the loan balance is of 764. So this family, when they bought it in 2022, they bought it for 785 and the loan balance is 765. So they probably only put $15,000 down. I mean, they've only owned it for, about 2 years. So they certainly haven't paid down their mortgage very much. But what is the home worth today, right? That would be the next question. So to really give you a quick assessment, that's why we include Zillow. And I'm not a super huge fan of the Z estimate, but to save a lot of time, what this does is to give us, a rough ballpark of what this home is likely, the market value is likely worth. And Zillow is not always 100% accurate, but certainly it gives you a starting point. So this home is probably worth maybe around 810 right now. So that gives you an idea of, the loan balance is 765. It's probably worth about 810. So that would give you a rough ballpark of what the down payment would be. And one point on that is by next week, we're actually modifying this display and we're going to actually display the down payment. We're going to do that math for you and tell you what the down payment requirement is likely to be. And then also make that a searchable component, add it as a search filter, probably in the price column. So if you have a buyer who only has $100,000 cash, so a home that has a $200,000 down payment requirement, obviously would be a hard thing to do. So we're going to make that a filterable item so that you can search for only properties that have a down payment for which your client has the ability to cover. And then again, that'll be displayed on the individual property page in our property listings going forward, starting next week.
Thank you.
All right. I think I'm complete, Gary. I've talked enough tonight.
Okay. Hey, question for you. The way our team is structured, we'll have like 2 people in Tampa and 2 people in San Antonio and 2 people in San Diego. I mean, sometimes there's 1, sometimes there's 3, sometimes there's 4. But can like 2 agents share this in one area? How does this, when you sign up, do you get access to the whole country, or is it just
Yes.
your area?
One
Oh,
account gets access to the entire country.
okay.
So I made that decision early on that I didn't want to limit agents' ability to search for properties. And so, if you're an agent in Virginia and you may have a client moving to Florida, well, heck, you can help them at least find a property. Now you may not be licensed there, but you can at least do some initial preliminary research for them. I don't think sharing accounts is probably the best idea, because remember, when you start saving searches, and the other feature we're actually building in that'll be available next week is listing alerts. So let's say you have a client who wants to buy in a certain town or a certain neighborhood at a certain price point. You can save those criteria, and then anytime a new property comes up for sale, an assumable home that comes up for sale that matches that criteria, you could set it up where both you and your client will receive real-time listing alerts. Hey, this new home that meets your criteria has an assumable loan. Here's the interest rate. And they'll see it as soon as it hits the MLS. You'll see it. You'll be the first to see it. So when you start sharing accounts, now you start having, different clients getting different information, and it can become problematic. But yeah, all accounts have access nationwide. But every agent should have their own account is really the best way to proceed, just based on how the tool is designed. Because you can add comments, you can see if a client added a comment, the agent would be able to see that. So if you're sharing accounts across multiple client or multiple agents, that becomes a little bit cumbersome. Who's that belong to, or what those comments are for, can become confusing.
Okay. Hey, I'm Dwayne Lee's from Brentwood, California, which is East Bay, kind of your Danville, Walnut Creek and all that. And he's just asking any timeline on Northern California?
Yeah, so actually, we're going to be launching in when we launch in California, we're going to be launching in multiple MLSs simultaneously. So the original plan was just Southern California, LA on south. But I think realistically, we're going to be in San Francisco, really Sacramento on south. So San Francisco, San Jose, Sacramento, really there going south. And I would say it will happen in the month of March. So probably sometime first or second week of March is really what I'm hoping for. So sometime during the front half of the month of March, we'll be in California. Again, Sacramento, San Jose, all the way down through LA, San Diego.
Okay. Jeff Johnson says that the answer, Jeff Johnson, is it's like Florida. You've got parts of Florida, but not all Florida. Same thing with California. So Jeff was just asking if
Florida, we're expanding because again, we're in Stadler MLS, and so I know there's Beaches MLS, and then there's the Miami-Dade MLS, and then up in the Panhandle, there's the Tallahassee area has a different MLS. So we're in the process of subscribing to all those. Actually, I'm personally licensed in Florida, so it makes it a little easier. I'm not licensed in California, so I have to go through a brokerage relationship out there. But we're going to be launching in other parts throughout Florida. I would say certainly by early April, we'll be into those other markets in Florida, across the Panhandle, Jacksonville, and all the way down into like Fort Lauderdale and Miami-Dade County. So plan on us being in greater Florida, I would say certainly in the late spring timeframe.
Hey, Mike.
Yes.
Yeah, this is Jeff. I just relocated down here to Florida. I saw that house, and I might call those people up. I'm actually looking for a place to live in, and so your Tampa also covers the St. Pete area, correct?
Yeah, if you go to assumus.com and you click on Tampa, we list every single county that we're live in, and so that includes off-market data, and MLS active listings. So yeah, so St. Pete, Brandon, Clearwater, Sarasota, all of Pinellas County, all of Tampa, Hillsborough County, and then going east into Orlando. We covered that entire area. Absolutely.
That's good enough to start. That will keep me busy for a moment.
There you go.
Thank you. Very good information. Thanks, Gary, and everyone else for having them on. This is awesome.
Gary,
Jeff.
what do you guys call your team? I'm trying to think of a good name for a discount. What do you guys? I want to come up with something that would be unique to you guys.
So we're
GIA.
the
GIA.
Global Investor Agent Team, and GIA for short. Yeah.
So we're going to do I'll just do a coupon of GIA 10 off. So GIA 10 off gives everybody 10% off a subscription, and it's perpetual for monthly subscription. So if you're interested, I'm going to go ahead and I'll set that up. Give me about 15 minutes from now. I'll set that up. Anybody's interested in subscribing. And of course, if you have any questions about the platform, let me know. And also feedback. So I want to make this as beneficial to subscribers as I can. So if you have ideas, a lot of these features that I talked about tonight came about through feedback from other agents and other users. So if there's other tools or other capabilities that you want, let me know and we will build them. And I've got a really good development team, and we're early in our release. We only just launched, really about 2-3 months ago. So everything you see here has been about 1.5 years in the making, but we're able to adapt and adjust very quickly. So if there's more features, anything new you want to see, a capability that you're looking for, let me know, and we'll build that in, and I'll make that happen relatively quickly.
Okay. I want to ask you real quick favor. I see Joanne actually has a live one. It's in a chat. If you wouldn't mind, just give her a pointer or two. She wants to know how to proceed. She's actually got one right now.
What question am I looking for?
It's Joanne Bond. She's up above. If you start at the bottom of the chat and work your way up just a few chats, you'll see it's she starts. I have a buyer interested in buying a listing that has an assumable USDA. It was at 8:03 p.m. and she's asking how does she proceed?
Okay.
Yeah,
so I have a buyer interested in buying my listing that has an assumable USDA. So where is this property located? Do I have my seller get the paperwork? Okay. So how do you initiate this process? So generally speaking, how this works, I think across the board, whether it's USDA, FHA, or VA, the first thing that has to happen is you have to get ratified. So you need to accept the offer. So the buyer has to present terms, and those terms need to be acceptable to the seller. And once you have a ratified contract, you take that contract and you submit that contract to the servicer, and the seller has to call the servicer. So step one, the seller calls their existing mortgage lender, the servicer, and say, hey, I'm selling my house. I'm selling it to a buyer who's going to assume my mortgage. And here are their names and here's their contact information. That will start the process. The seller, the servicer will open a file with that buyer's name and contact information, and then reach out to them and have them submit an application. They're gonna the bank is gonna use the servicer is gonna have their own application process. Every lender has their own way of doing it. Usually it's a website they'll send you to, and you'll complete this online application just like they were going to complete an application for any other loan for any other lender they would work with. So that starts with the seller calling their servicer and informing them that they have a buyer who's going to assume their mortgage, and the seller needs to provide that bank with the buyer's contact information. The bank will then open a file and reach out to typically email those buyers and ask them to complete an application. In the meantime, the seller will provide a copy of the ratified sales contract and set here's the timeline that we need to work with. Really good question is, one, do you, what's your typical processing time? USDA assumptions, I don't think there's any mandated time frame. With FHA loan assumptions, there's not a mandated time frame, but for VA loans, there is a mandated time frame, and that is 45 days. Servicers now have 45 days to complete the processing and make a decision on whether a loan can be assumed or whether the buyer wasn't qualified. They can't say we're not going to do it, and they certainly can't sit on it for 30 days, waiting for a processor to be assigned. They have to make a decision within 45 days of the application, of this borrower submitting their application to the servicer.
Yeah. So guys, real quick, when you have a buyer, make sure they get pre-approved. I'm telling you, it'll help the process.
Yeah, you definitely want to have, if you're representing a buyer who wants to pursue an assumption loan, just have them get pre-approved with an existing lender, whatever your preferred lender is, have them get pre-approved first. That'll simplify the process, because any seller who's selling their home is not going to accept an offer. And there's no difference in the offer itself. There's no form, there's no special document that has to include in the offer to let them know that it's going to be an assumption. You're going to submit an offer like you would any other way. Just be kind of judicial in the closing time frame. Don't put an assumption, a loan offer to buy a home with an assumption loan with a 30-day closing, because it's not going to happen in 30 days. You're probably going to want to at least do, at a minimum, probably a 75-day closing at a minimum. And hopefully that seller is willing to do that. Some sellers may not want to close in 75 days. Maybe it only takes 60 days from the time of ratification. But remember, at least with VA loans, from the time the buyer submits the application until a decision is made, meaning it's approved, the maximum amount of time the VA allows is now 45 days. So there's a couple of days at either end, to get the name and get the loan application submitted, and then go to closing. Figure another week to 2 weeks on either end, at most maybe a week on either end. So you're still talking about a 60-day closing at best for a VA assumption. So if you're putting a VA assumption package in, or an offer to assume a VA loan, you're going to need to do at least a 60-day closing, and be prepared to do an extension. Maybe you need an extra week or two if you need at the back end. So don't expect these to be super fast. And also, some servicers don't like to talk with agents, even though you have a representation agreement. Servicers don't always like to communicate with their agents. They'll only, generally speaking, speak with the seller and the buyer. So the seller and the buyer, the two parties of the transaction. And a lot of lenders don't like to talk to the agents, although I've been pretty successful at building rapport with this processor, and we try to kind of help the process along and be helpful. And so in doing so, sometimes they'll CC you on those emails, but generally speaking, they'll only reach out to either the seller or the buyer to process that assumption.
Yeah.
Great.
Hey guys, I know PF and Anna have their hands raised, Mike, if you don't mind, but guys, we'll have to wrap it up after PF and Anna, because the most important person in this entire class is a young girl named Sarah who wants her daddy.
She wants her bedtime, but that's okay. We're good. We're good for it.
Yeah.
That's fantastic. My question is rather quick. I'm in Massachusetts, and you're not covering the Northeast until much later in the year. Will the coupon be valid?
Yes.
Later?
I'll keep this coupon valid indefinitely, so it'll be permanent. So even as we open up new markets, you'll have this available to you indefinitely. Absolutely.
All right. Thank you.
Yep.
Anna, still there? Anna G?
So here, yes, sir. Thank you so much for an awesome presentation. And Bonetta, thanks for bringing him forward, because this was absolutely phenomenal. Thank you so much for your time. I'll try to make it quick. I'll have two feedbacks. I'm happy to share that via email in case you're running out of time. But I wanted to ask, what data aggregators do you use to gather the information? Is it Block Night? Is it individual servicers information, or at least for the active ones, the active listings, are they pulled from the MLS?
Okay, so you're getting into the nuts and bolts of kind of our secret sauce, Anna.
Sorry.
Yeah.
I'll give you. Oh, sorry. Go ahead.
So where we get our data from is various sources. Many of you may know that public record data. So public record data does provide some information. So generally speaking, whenever you sell a home, what's recorded in the land records, the county land records or city land records is usually, the name of the name of the borrower, the property address, whether it has a VA or conventional or FHA loan. So all that's recorded in public record. And the amount that the original loan amount is also recorded in public record. What's not in public record is all the other information, the interest rate, the loan balance is what we provide, the current loan balance, and then the mortgage payment. So that stuff, we capture, and then off-market properties, we include, the property size, the tax information, square footage, garage information, bedrooms, bathrooms, etc. So all that is kind of, we aggregate that. We kind of have contracts in place with a bunch of different, I'll just call them, real estate data aggregators, and we pull it from various sources. So I'm not at liberty to say where we're getting it from exactly, but we do pull it from various sources, and we do clean it, and we make sure it's to the best extent possible accurate. We look through it all, and if we find anomalies, we address those anomalies. But yeah, we try to provide as close to as accurate as possible information as we can. And then we take all of that data and then we merge that with live MLS data. So the property description and the photos that you see, all those photos are pulled from MLS data. So we have a live feed directly into the MLS. And so we take all of our kind of proprietary data, and then we merge that with MLS data. And that's what makes it searchable on the MLS. And that's what makes it really powerful, is that you get what you normally wouldn't have access to from the MLS, and then we add all that really good, useful information about assumption loans, and merge that together, and that's really the power of this platform.
I appreciate that, and I'll share the reasons why I was asking. I've come across of transactions that I've worked on where Black Knight reports loan information that was inaccurate. And also on the MLS side, I'm currently working with a VA eligible buyer who's looking for a VA assumable loan. So this would be perfect. I'm in Texas though, so it seems like I still have to wait for you to launch. But what I'm seeing for him is since they're quite limited. So what I is search results that look at the remarks and look at the keyword assumable. And those are the ones that I'm able to send to him. They're so limited. And so I don't think that in the area of San Antonio, I only have like 22 options as the MLS is showing I have. So that's why I was asking the sources
great
are
question.
coming
Yeah.
from.
So only about 10% of homes that have an assumable mortgage are listed as such in the MLS, meaning that the agent included a comment or made it somehow searchable. So 10% of the total number of assumable mortgages are only searchable through keyword, right? So that's what you're finding right now is there's going to be 4 or 5, maybe as much as 10 times the actual number of assumable loans truly available for sale in your market. You just can't access them, at least not until I bring Assumless to Texas. I get a half dozen or so inquiries a day asking me when I'm coming to Texas. So trust me, it is on the short list. I'm moving there. I'm going to be launching there probably, I can tell you right now, as soon as we finish with California, which will be early March, our next state will most likely be Texas.
How about Nevada?
Hello, Nevada?
Nevada, it's going to be, Nevada, Colorado, and Texas. Oh man, I say that and everybody's like, I'm in North Carolina. All right, we're growing as fast as we can grow, right? We are literally doing this on the fly, right? We're in the air and the airplane's being built. So yes, I recognize there's a need. I can't say with 100% certainty that all of our data is 100% accurate. There are some anomalies in the data, and frankly, that's why we pull it from multiple sources, because we try to streamline it and find and weed out those anomalies. So I apologize if you see a couple of properties, maybe 1 or 2 properties. You might like, well, that looks a little odd. The biggest anomaly I think we find is that some people bought a home with a conventional loan, and then they refinance into a VA loan, or they refinance into an assumable mortgage, and that refinance is not captured in public record. And so sometimes I can't get access to some properties that were kind of purchased in a weird and nuanced way. And sometimes I find like that property has an assumption loan. Why is it not in my database? And I look it up in like the MLS, or I look at the county tax records, and I'm like, oh, that's because, some scenario happened where, it was refinanced or there's an anomaly. Sometimes it's not even reported in the tax records, and the homeowner did some type of creative financing and it's not reported anywhere, and yet it still has an assumable loan. So I've come across those as well. Very, very few and far between. I would say 1% of assumable. That what I'm talking about is, maybe 1 or 2% of all assumable mortgages fall into this little, this kind of anomaly area here.
Hey, Mike, I got a quick question. Is this something we should be asking our sellers? Because I have a couple listings coming on. So will we call the lenders and say, hey, is this assumable? How would we find that out?
All you have to do is ask the seller, hey, do you have a VA loan, an FHA loan, or USDA loan? Your seller will know the answer to that question. And if you do, I generally advise listing agents to include a comment in your listing that this home has an assumable mortgage, assuming it has a low interest rate assumable mortgage. I mean, if they have a 5.75%, probably not all that valuable, but if they got a 3 or 3.5 or 2.75% interest rate, I absolutely will include I recommend including a comment in there and saying assumable mortgage, 2.75%. Here's the loan balance. If it's in an area covered by assumers, we'll already have that captured. But for the people that don't have it, so if you're a listing agent and you want to really maximize the visibility, because like what Anna is running into in Texas right now, this would solve that problem for her. And what we find is properties that are listed with an agent comment as having an assumable mortgage, generally speaking, will have more interest and more offers. So if you want to improve the potential number of offers you're getting on a home, potentially improve escalations or the sales price, including that data generally attracts more buyers. It's picked up and syndicated on Zillow and Realtor.com. And you'll see that buyers are interested in those properties more so. It excites them and they want to see it, so get more showing requests, et cetera, et cetera, et cetera. So I always recommend including that in the comments.
So I got a slight challenge. One of my sellers is now deceased, and then the other one is 82. He ain't on here. Okay, so what do I do in that case? Should I call the lenders? Do you think they would share that with me?
They won't share that with you. What you could do, the lender won't talk to an agent without the borrower the homeowner being on the phone. So you can maybe do a 3-way call, or you can call, if you meet your client together, you get them on a speakerphone. That'd be the way to do it. You can ask to look at the copy of a mortgage statement, or they can email it to you, or if they have online access, usually the stuff you can find out online. But yeah, calling the lender directly, saying that you're representing a buyer or representing a seller, the lender's probably not going to talk to you. So the seller would have to really help you out. They would need to take some action to help you answer that question.
Is the information usually on the mortgage statement though? And that's my last question.
Sometimes it is and sometimes it's not. It depends on the servicer. You could sometimes pull it up in the tax records. So if you pull up in the county tax records, you may actually say when it closed, it would tell you the type of financing used. It would say VA or FHA. It does in most states. I know it does in Florida and most of the states in DC, Maryland, Virginia area. So I can't speak for all states, but that's another quick way as an agent. You can just pull it up in the public records and in the tax records. It usually says there. So that would be, yeah.
Assumable, all the VH and FHA. I said that was the last question. All of them are assumable?
VA, every single VA, every single FHA, and every single USDA is assumable. Yes, 100%.
All right, thank you.
All right. Any final questions?
Radislav has had his hand up for a really long time, but he was on a different screen, so nobody saw him.
It was the Nevada question. Yeah, we got it. Yeah.
Oh, that was just for Nevada, and that he didn't have another question?
Yep. I don't think so. And Mike, I just want to say thanks, and to you, your wife Bethany, and also your daughter Sarah, for letting us have you for so much. I mean, 1 hour and 45 minutes, guys. That's a lot of time. And so that, Mike, this has been a big big bonus for us for you to stay on this long and do this. We really certainly appreciate it. So you put your contact information in the chat box, right?
I did. Yep. Mike at assumeless.com. I'm going to program that 10% off coupon which is the same discount I offer veterans. So you basically will all the GIA team here will get the veteran discount, 10% off. If you have any questions about the platform, email me. If you have any feedback, if you want to, if there's something that I can do to help your business, if there's a feature or capability or something that would help you do your job, let me know. I would love to incorporate that into the platform. And I wish you all the best, and thank you so much for your time.
You're welcome. And we'll have Beverly put this information also. She sends the email out tomorrow with the recording, and we'll put that in that email also. So everybody, you'll get the email tomorrow. You'll have the information tomorrow. Feel free to reach out to Mike. You can reach out to me too, and Bonetta. You know, we'll be able to coordinate things. But let's work together as a team. Take advantage of this. Remember, it's growing. It's already in some of the markets. It's growing in some of the other markets, and I'm sure there's a logic to this, and it's as far as what markets are coming up next. So just bear that in mind. And this is an awesome tool. Would you guys agree this has been an awesome class? If you could give Mike and Bethany a big pat on the back, big hand raise. Yep, chat box if you want. And how about everybody just say thank you, Sarah?
Thank you, Sarah.
Thank you, Sarah.
There you go.
She's watching her iPad next to me, but thank you guys. Really appreciate it. I hope this brings a lot of value to you. Remember, it's about marketing yourself to be value added, and this is a way you can differentiate yourself from your competitors. Whether or not your buyer, your client actually proceeds or moves forward with an assumption is not really the point. It's the idea that you're converting leads into clients and you're doing more production, you're getting more sales. You're bringing buyers in off the sidelines. You're helping sellers that want to sit tight, and you want to give them an opportunity to move, and you give them a way to look at that promises differently. And so really that's what this conversation is about. And this tool really helps you and equips you and gives you something in your tool bag that most agents really don't have a lot of knowledge on. And that really helps you convert and improve your business.
You got it. Thanks, Mike, and thanks everybody. And Radoslav, I forgot to thank you, Radoslav, for your question. Thank you for your question, and everybody for your questions. Thanks to the guests for coming on, other agents from other brokerages and investors. Hope you like what you saw. You can join any Monday night you want. You know, I teach half the time. Half the time we have guest teachers like Mike and Bethany. So keep that in mind. Just stay in contact, stay in touch, keep communicating with each other. The market is starting to heat up. I can already see it in the transaction volume. Remember, I told you last week, don't wait till April. Now's the time to get out there and communicate with people. Contact your sphere. Here's what I want you to take this with you guys. Your sphere, your contact records on your CRM should be converting at 10%. If you're not converting 10% of your database on a consistent basis, please set up a call with me. Okay. Come to class, but more importantly, set up a call with me. I'm going to help you get to that point. All right. And what Mike and Bethany are presenting here is an incredible tool. You know, the market is heading that way. More people are going to be looking for mortgages to assume with those low interest rate mortgages. And there are parts of the country where transaction volume is dropping and prices are dropping too. These are real facts. I know it sounds crazy, but this is how markets turn. It's Northern California, Austin, and it works in San Antonio and Austin. Austin was down 11%, guys. Okay. So this is the time to prepare is now. This is one awesome way to prepare. So I'll see you on the one-on-ones. I'll see you next Monday Night Live. You guys take care of yourselves. God bless you and your families. And have a good night.
Thank you for watching this episode of Monday Night Live. Be sure to subscribe to our channel and go to realestatewithgarywilson.com to join our community and start building wealth today.